Welcome, everybody, to another episode of The Chart Book. You can see Cambria Global Headquarters during the pandemic. This is my office. You can see my levitating plant, my Knights hat. I'm not a fan. I'm an Avalanche guy, but I think this was the last sporting event I attended before the pandemic started. I hope everyone is safe and healthy. Today we're going to go through a bunch of charts again. Thought it would be a lot of fun to start with. If you look at one of my favorite paintings in the back of the office, it's a Western painter named Bev Doolittle. Anyone heard of her? Anyway, this is one of my favorite paintings because it's called Double Back, but as you can see, there's a giant grizzly bear hidden in the painting. She does a lot of hidden stuff, but that kind of describes the way I feel about markets right now. After our massive run, after one of the quickest bear markets in history. But let's run through some charts, some posts, some ideas. The first one is, we had done a post that I put a lot of blood and sweat into in mid-March, right at the depth of things going a little crazy. And I'm going to read just a little bit of it and use it as a jumping off point for some things to talk about because it's useful to illustrate how we all felt at the time during things when they were going crazy, and then walk forward to now. So we started this post by saying -9, 5, -5, -10, +9. And those, if you remember back, were the daily returns of the stock market just in the past week in March, enough to give people an ulcer. And the way I wanted to frame this is I said, the coronavirus is wrecking economies, overloading health systems around the globe. And due to the uncertainty involved, and you guys remember back without the benefit of hindsight, you could easily make a case for a couple different outcomes. Because so many people wanted to be binary in their thinking. And the hard part with markets is you have to be able to envision multiple possible future scenarios. So we said, look, here's the bull case, and I'll read it. It said, following the dire experience of Italy, countries around the world take the threat seriously. Tests are plentiful, events canceled, citizens self-quarantine. Governments around the world coordinate fiscal, monetary, and healthcare policies to address most major threats. The infection rate peaks soon. And I said we'd already seen the number of new cases in China drop to single digits. Hospitals well-staffed, able to manage the patient load. Death totals are mild. Treatments are developed. Vaccines distributed, and global immunity prevents any future outbreaks. Economies and markets rebound vigorously. Citizens around the world are euphoric, and risk-on markets rebound with a fury not seen in decades. Financial markets hit new highs by year-end, which is sort of seen where we've come, by the way. That didn't seem altogether possible. Obviously, the vaccines aren't developed, and treatments, for the most part, aren't there. But almost everything else came true in that. But we could have had a scenario, and let's not jinx ourselves, knock on wood, the bear case could have possibly happened. It still could. So go back to March, and I'll read it. Some countries around the world take the threat seriously, but it's too late. The virus has already spread too far. Much of the global population ignores suggestions of self-quarantine. Cases go exponential. Hospitals are overwhelmed, unable to manage the patient load. Death totals soar beyond expectations. World leaders, celebrities, and athletes are not spared. And by the way, this is one comment I would want to add in here. One of my thought process in the beginning of this is I said this becomes much more personal the more people know someone that has it, in particular if famous people. Remember when Tom Hanks got diagnosed with it early, you started to see the reality of it. But for the most part, we haven't seen, other than some major world leaders getting the virus, lots and lots of famous people die. And unless you're outside of some of the main coronavirus centers like New York City and Italy and the hotspots, most people, when we were doing a poll, still don't know someone who's had the virus. Let's go back to the thesis. Most people know a friend or family member that dies from the virus. Treatment's ineffective. Vaccines years away, and the experiments with herd immunity are a disaster. Governments try to implement various financial and social stimulus policies to no avail. Previously expected to be a short-term problem, economies and markets are impacted massively. Citizens around the world are fearful, depressed, and risky financial markets continue to plummet. Stock market declines by a third. and this is what happened, taking it back to the historically average CAPE ratio valuation of around 18. Oil, real estate, gold, and most financial assets slide as well. The summer brings some relief from the virus. Economies improve as markets stabilize. People sense the nightmare is over. However, by fall, the virus reemerges, prompting despair among global citizens, and markets continue to valuations not seen since the bottom of the global financial crisis, another 30% down to a long-term valuation around 12 and 60% down from the peak. And then I said, what scenario is most likely to occur? And if you went back to March, I think most people probably would have said the bearish one. But I said, look, I don't know. No one really knows. The reality is likely somewhere in the middle. And I said, with such massively different future possibilities, many investors wonder what to do. And the answer for most of us is nothing, or at least as the late John Bogle stated. He'd say, my rule, and it's good about 99% of the time, so I have to be careful here. When these crises come along, the best rule you can possibly follow is not don't stand there, do something, but don't do something, stand there. And we tried to, we wrote a letter to shareholders at the time called Time to Panic, and you can go back and read the whole thing from this link on the blog. But here's a tidbit from it. It said, global markets are experiencing large moves up and down, and many investors are freaking out. U.S. stocks declined enough at the market open, 7%, to trigger circuit breakers that pause trading. Investors all over social media are panicking because they don't have a plan, but you do. You put in the work over the past decade, you've read our blog posts and books, you've listened to podcasts, and eventually you built a plan. And take note, they're not all the same plan, but at least you have one so that when it hits the fan, like it is now, you're prepared. And so I'm going to summarize the rest of this real quick. You can go to this blog post, and it's called, again, Investing in the Time of Corona. Tons and tons of links here. But we talk about a lot of our old pieces over the past 14 years about how daily stock market moves of 5 to 10% are actually normal, and they tend to cluster together. We saw this again in Q1, but that's particularly in downtrends, and that was in a paper called Where the Black Swans Hide. We talked about the 4 quadrants of stock markets, and we talk about when an expensive market flips from an uptrend to a downtrend, things get super nasty. We talk about how, what assets tend to hedge during these big down periods in a piece called Worried About the Market, and we'll touch on this in a future episode on tail risk. And not surprisingly, in Q1, the playbook was actually pretty close to the historicals, where the assets that you expected to help hedge, the assets you expected not to help, foreign stocks, real estate, to some extent commodities and energy didn't, and the ones that historically did hedge, bonds, gold, did well, and the strategies like trend following and of course tail risk insurance did exceptionally well. We talked about how many assets can go long periods of having terrible returns in a piece called How Long Can You Handle Outperforming? And then, of course, if you want a really long-term perspective, 2 companion pieces, the Get Rich and Stay Rich portfolios. Obviously, I outlined how I do this with all my own money in a piece called How I Invest My Money. Here's an old piece of me walking through a farm in Kansas. I love that photo. So anyway, we kind of go through a bunch of more stuff in this post, but we said, look, for most people, they shouldn't be doing anything at all. You should have had this plan already in place, much like Peyton Manning before he comes to the line of scrimmage, knows what's going to happen. There's no defense that's going to surprise him. However, there are some things you can do to really take advantage of the situation. And so I said there's 3. The first one was a concept we talked about with Rob Arnott and Howard Marks on some podcasts. And Rob described it as over-rebalancing, and Howard Marks talked about it as calibrating. So if you have a portfolio and things get totally out of whack, and you had stocks and your target was, say, 60-40, a smart thing to do is rebalance back to target. But you could say if things went super crazy, you could actually rebalance a little more. And so I'm not talking about going from 60-40 to 90-10, but rather say maybe 65-35. And that applies to things that we'll touch on a little bit, like value, like foreign stocks. But it's really about turning the dials, not a whole binary shift, which is the way most investors love to think about gambling. Am I in or am I out? Are stocks expensive? Should I have all my money in stocks or all of it in bonds? And that's not the way to think about it, particularly during crisis, because people are using their emotions and going crazy. The second one, which is a little bit esoteric, is an idea about buying $1 for 50 cents. And we wrote about this way back in my first book, The IV Portfolio, and I've talked about it over the years. For the most part, ETFs trade pretty close to net asset value. Mutual funds, you buy it, you're going to get that NAV. But there's certain types of funds called closed-end funds that don't have that arbitrage mechanism that keeps them at net asset value. So you can have these funds that'll trade 10, 20, 50%, even more discounts to publish net asset value and premiums too. So in times of crisis, and this happened back in the global financial crisis, and we were writing about the time, some of these funds get blown out to where they're trading at 50% discount to net asset value. Now, in general, we don't recommend investing in these types of funds because they tend to be really expensive. They have high expense ratios, 1%, 2%. A lot of them are leveraged. And so you don't want to own these funds for many years. You also don't want to own the ones where if they trade at a persistent discount. So if they trade at 10%, 20% discount and always sit there, you want the ones that kind of oscillate. And so there were a couple this year that we wrote in real time, and we'll talk about it in a second here on Twitter. The first of which was, let me jump to it real quick and we'll come back. The first of which was Bill Ackman's Pershing Square. And so this is a hedge fund that trades. His portfolio was a straight up, we wrote about this in March, a 40% discount to net asset value. And almost never do I talk about individual positions anywhere. Everyone knows how I invest my money. I'm very disclosed about it. I want it just on autopilot, but like to take advantage of certain things when they present themselves. And in this case, I didn't think the market was really understanding what was happening with his fund. His fund was trading at a 40% discount to net asset value. And on top of that, he'd had on a big hedge that really helped in the first quarter. So we talked about this, and you can go to places like Pershing Square's website, PershingsquareHoldings.com, that'll show all the weekly net asset values, and they straight up update the portfolio. And then this is closed mightily. The fund has done really well. You can see it's up almost 26% year to date. But this fund was trading at a huge discount. I no longer own it, have sold it. But that's just meant to be instructive, okay? So you can kind of get an idea that things go crazy when people panic. Some of that may be built in. I think Bill Ackman there's a lot of people that have very strong opinions about him, many of which are negative. He went on to CNBC and was talking about how, it was kind of a bad look where he was talking about the market imploding, but was actually covering some of his hedges. Anyway, but this applies to any fund. So there's some good websites out there that let you sort closed-end funds. I think one was called Closed-End Fund Connect. But if you Google some of those ideas, you can see the premiums and discounts. And Morningstar covers them too. Anyway, as an aside. But let's go back to the piece on investing in a time of Corona. We say, let's walk forward. It's been 2 months since we wrote that piece. And I don't think many people in March would have said the most likely outcome is the bull case. And we're pretty close to that. The stock market's down single digits now. NASDAQ's up on the year. But that's actually what's transpired. And so we'd also talked about this in mid-March where we said, again, in our old book, we used to talk about these reversion systems that when you have a really bad month in stocks, so we're talking like down 8, down 10%, historically the next 12 months is pretty strong. It's not guaranteed. So in this case, we said 12-month future returns after the 10 and 20 worst months in stocks averaged about 30 and 15%. That's pretty awesome. But again, it wasn't guaranteed. There was one time when you still went on to lose 2/3 of your money, but in general, we got the bounce. So April and May have been really strong. Who knows what will happen the rest of the year, the rest of the summer, but the bounce has transpired. So what else? That's caused the U.S. stock market, this run up, has caused the price and the price to earnings ratio to increase quite a bit. So the valuation, which got pretty almost back to average valuations during the bottom of the crisis, is now back up to a long-term price earnings ratio of around 28, which isn't cheap. It's not a bubble like 1999 when it hit 45, but it's back to a level where you should expect low single-digit returns going forward for the next decade. We'll update. We'll do one of these and talk about global valuations next week. This is the end of May. So we'll do it maybe in the first week of June to talk about a lot of the other countries in the rest of the world that are quite a bit cheaper than the U.S. One of my favorite research groups, we've had Doug on before at the Luthold Group. They just put out a chart today that talked about valuations and other metrics. And the interesting part is they looked at a lot of post-World War II bull markets and the conditions that accompanied them in the beginning. And they looked at valuations, they looked at momentum, they looked at advancers, decliners, transports, utilities, breadth thrust, all these sort of technical and fundamental variables. And they said how many of these conditions were met, at the bear market low. And all of these from 1949 to 2009 had a range of 5 to 8 of them were met. In the case of ours, the most recent one was 0. So the question is, if this is the end of this, or is this just a slight bounce in a longer term bear? Going back to our Bev Doolittle post, you could probably guess where I, if I had to bet over happy hour, thank God I'm a quant, where I would side on this, would probably bet if I had to bet that there's more to come. Here's a chart from Jeff over at Wisdom Tree where a lot of people have commented on this, but this is the outperformance over 10 years of cheap versus expensive stocks. And you can kind of see it zigs and zags and oscillates over time. And the last time we've seen such a big run within the stock market, if you just say stock market, it's not just, the S&P 500, but there's incredibly wide dispersion and differences between sectors and industries, as well as size and valuations. In this case, you're chopping up by valuation. You can see there's been a monster run in the expensive stuff relative to the cheap. In this case, this goes to show that it's been as bad as the dot-com era. So you had small cap value, if you remember back to Q1, at one point was down 50%. And so for the first time, you saw a really wide dispersion between the large cap weighted, market cap weighted, and small cap value. Small cap value actually got really cheap, in line with a lot of the foreign cheap stuff. Was a big opportunity. But you see people in the way they behave over time. This is Larry Mcdonald, one of our favorite authors and commenters, and he's got a newsletter called the Bear Traps Report. But he's got a stat where he talked about the percent of investors who believe value will outperform, which was almost a universally positively held belief from 2014 to 2019, which has then shifted, and this is the lowest it's been since 2007, which is an interesting takeaway. It's sort of a coincident indicator similar to sentiment. Here's a chart from SSRN. If you're not familiar with SSRN, it's the academic database. We're going to cough a little bit and say we have the number one most downloaded paper on here, which is pretty cool. Sort of like saying you're the best, going back to Bull Durham, saying you're the best minor league baseball player. But hey, I'll take my wins when I can get them. But it's like a rabbit hole, all sorts of really cool papers on here. Hat tip to Cliff Asness for mentioning this one. And we have the crew from Europe. Pim's been on the podcast before, so check out his podcast. It's a lot of fun on low volatility investing. But they went back and built their own database and said what happened to a lot of the equity styles during the Spanish flu, so 100 years ago. And they talk about how what went on is that they found that low vol, which is one of their favorites, and momentum did really well during the sell-off. But after that, when stocks ended up bouncing, small stocks and value did much better during the recovery phase, which is what you're starting to see. I don't know if you can say that value has totally turned the corner, but they seem to be bouncing pretty hard over the past week or two. Fun paper. Check it out for the nerds out there. Larry, our favorite squatter, had some good comments here. This was a retweet of S&P 500 indices. We talked sort of ad nauseum about this, about how investors love to have home country bias, and S&P was right on here. And this is a chart showing that the amount of market cap of the U.S. is a percentage of the world. It's above 50% right now, and international investors, it's better than they used to. They used to only have 10, but they're only a third invested in the U.S. You see big gap between. This is just the default index, the light blue line. So they're making a massive overweight bet on their own countries, the same way that U.S. investors do on U.S. stock markets. Almost always foolish, drives me nuts. So we got back-to-back tweets from Hamtel here. He talks about Baupost, one of our favorite hedge funds out there, Seth Klarman. We had one of his disciples on the podcast recently, but Seth, one of the best fund managers out there. If you find his book in a used bookstore, put it on eBay because it goes for about $1,000 margin of safety. But he found a compilation of Balpost fund letters from the late 90s that are a lot of fun to read if you get a chance, that probably may not stay on the internet for long. So check it out. We covered Balpost and Klarman in our book, Invest with a House. So if you go to CambriaInvestments.com, these books are free to download. Enjoy. Let me know what you think about them. Invest with Our House is one of my favorite books, by the way. You can see all the dudes on the cover, all the white dudes. We need a little more diversity here, but we got Einhorn and Charlie Munger and Warren Buffett and Julian Robertson, who's obviously retired. David Tepper is probably the GOAT of all. 13F tracking through government databases. His strategy did about 20% per year over the last 20 years. And then, of course, Carl Icahn, Soros doesn't really have anything you can track. And then Seth and Bill at the bottom. What else? So the fact book that came out from the Investment Company Institute, I think, is a good time to weigh in on implementation and trends in our world of investing in asset management. And I thought it'd be interesting to illustrate a few of the charts that we talked about in Twitter. The first being is that you see this continual trend of money moving out of active mutual funds, which tend to be more expensive and tax inefficient than where ETFs are, and moving into index mutual funds and ETFs. But you can still see, let me see if I can click on this and bring up a better, you can still see that despite the piece of the pie getting smaller for active funds, they're still by far the biggest chunk of assets out of the 20 trillion or so in net assets. So the trend is happening, and it looks really dramatic when you do charts like this. You say, oh my gosh, look at all the money that's going out of actively managed equity mutual funds and into index and lower cost options. But in reality, most of the money is still there. That's why we say that this is early innings for that trend to happen as the boomers and older crowd pass along, people get divorced, that money never goes back. But you see some positive trend. That's a positive trend. Here's another positive trend. Expense ratios on mutual funds. You can see that the average, we quote this average all the time, and people love to correct me. It's around 1.25%. The dollar weighted is a little bit better. That's largely just because of Vanguard and others. It's down around 0.5%. Still quite a bit higher than the global market portfolio you can get with ETFs now at 0 or 5 basis points. Same thing. But you can see that a lot of the flows and net assets are concentrated in the lower cost funds, which is a good trend. Excited to see that on average, and again, before you guys email me and harass me about this in the comments section, all that matters is net returns after all costs, including trading costs, fees, taxes, everything. The fact that you have a higher expense ratio doesn't mean you're worse. You can absolutely, the Renaissances of the world can charge 4 and 40. It just means the bar is a little bit higher. And you can see, though, that there's still pretty wide dispersion. Some of the median in some of these categories is crazy. I mean, if you look at the median expense ratio in like the bear category and long short, it's like up around 1.5, 2. So still a long way to go. Anyway, be mindful of cost, people. Good trends. Let's get into some fun stuff so we don't do this too long. Best podcast. We usually say this on Friday. People will actually email me and DM me if I hadn't tweeted this out. But we say, what's the best podcast you guys have heard this week? We actually pay a friend to listen to nothing but podcasts and put out the best ones each week to the Idea Farm. If you guys haven't subscribed, check it out, ideafarm.com. But on Friday, we let other people weigh in, all on occasion, post one that I think was really outstanding. Today, we had one such show from Rational Reminder Podcast, a couple of Canadians that were interviewing Professor Ken French, which was fantastic. If you haven't listened, please take it for a spin. He had some great quotes. We'll outline a few here. One, he said, people are crazy when they try and draw inferences that they do from 3, 5, or even 10 years performance on an asset class or any actively managed fund. And I agree with that. It's so funny. People love talking about what happened this week, this month, this quarter, even this year. And we often tell people, you really want to have a 10-year time horizon. Not now. I say it's 20. I mean, if you go back to the fact that there's no more ironclad belief in all of investing than stocks outperform bonds. Well, about a month or two ago, you'd gone through a period of 40 years where U.S. stocks had underperformed or equal performance long-term bonds. I mean, that's 4 decades of there being no equity premium. So people always talking about a year or two of performance, really you need a decade at minimum. But he has and I made the joke. I said every investor tells me they have a long-term horizon, then quotes yearly, quarterly performance. Today, no investor has ever come up to me and said, we plan on allocating and we'll judge our strategy over the next decade. And even then, we know that time frame might be too short. I've yet to hear that from an investor. But he also had a great buyback quote before I get destroyed for this. He said, buybacks are divisive. They divide people into people who understand finance and those who don't. And I'm gonna pause on that one. I'm just gonna skip that one. And the last great quote from the podcast, he says, when I want to judge the quality of an investment decision I made, I don't pay much attention to the outcome. I pay attention to, did I make a good decision based on the information I had at the time? You hear almost every investor talk about, hey, I'm all about process, not performance. And that may be true when they actually buy an investment, but universally, people almost always sell a fund or investment based on performance, and usually it's because of underperformance. You never hear someone say, oh my God, this fund or this strategy did so much better than I was expecting, I have to sell it. Doesn't make sense. So think about that. How much of your investing strategy is really about process and how much of it is purely driven by performance? This is a really nice resource post from Brent Beshore, based out of Missouri. Permanent Equity is his firm, and this is a bunch of data resources for small businesses. You guys can check it out and spend some time on it. PermanentEquity.com is his site. A couple more fun things I had posted this week. Let me know. I didn't hear many responses to this, but you guys know, the followers, I'm a big fan of subscription boxes, the delight that comes with it, the surprise. And then as an investor, I've been invested in a few of these. The annual recurring revenue is such a wonderful business model. But here's some that I currently subscribe to. For the ladies out there, my wife, I actually subscribe to Scentbox for myself, but FabFitFun is a big LA-based one my wife loves. And despite the brand being kind of douchey, if I can think of a different word, GQ actually puts together one of the best. So I used to do bespoke posts for men's interests, but I feel like they kind of kept sending the same stuff. Earthbox, great for snacks. Trade Coffee, Bar 9, both awesome for coffee if you're a coffee addict. Esther's Wine, my favorite LA-based wine shop. Petite Vour, another female-focused brand based out of Texas that's cruelty-free is sort of their mission. Just started Chef's Garden, a big distributor to kitchens and restaurants that got hurt during the crisis. They put out an awesome box of veggies. I can't get it here, but there's a couple others like Misfit and Imperfect Foods. A lot of people love. And then last one being Literati. So if you guys, that's for my 3-year-old. If you guys got any good suggestions, send them over, put them in the comments. Would love to hear them of ones we should try. I saw this. This is from Front Office Sports. There apparently is an Airbnb AA affiliate of the Twins where you can rent out an entire stadium. We need to do a meetup here, rent out the park for a whole day. It's only $1,500. We could probably chip in and get that no sweat one day. What else? Oh, Anthony Evans. This is a great example. I'm spending obviously a lot of time with my 3-year-old trying to do some homeschooling. This is a good lesson in math. If you guys see the joke here, I'm not going to get it, but a useful extension of power laws of mathematics applies to investing. If you guys remember, we talk a lot about in public markets as well as private about all the returns are determined by about 5% of the companies out there that have the massive 10, 100,000 bagger wins. Indexing is one way to own all of them. Obviously, if you own them in more concentrated fashion, even better. This is pretty funny, given all the discussion on social media, truth, etc. with Facebook. Poor Mark Zuckerberg, always the butt of the jokes. I shouldn't say poor Mark Zuckerberg. Brings a lot of it on himself. But anyway, it was a funny tweet. It said, social media should not fact-check posts, says child molester Mark Zuckerberg. 2 more. My favorite chef in LA, Nancy Silverton, who actually had coronavirus. I hope she's recovered. She has my favorite pizza recipe on the planet for dough. If you guys want to look it up online, we've linked to it many times. It's awesome. You can freeze it, keep a bunch for later. Most pizza dough is kind of chewy, doesn't cook up this well. This is perfect. Those like Neapolitan Italian pizzas, very thin. Anyway, she's got a book for quarantine called Cooking from Her Pantry, Meals in 30 Minutes or Less. There's also a great Instagram account from Michelin ratings where they have chefs that will do some of their favorite recipes A lot of sweets on there, a lot of unhealthy stuff, but I'm trying a few out. And for the nerds out there, we had an old post, see if I can find it, where we paid a couple developers to go and rank, and I don't get why this is not something that you can do, but to find the best recipes in the world. I wanted to find universal 5-star rated recipes that had the most ratings. I'm not trying to find the best recipe in the world, but rather something that everyone loves. So much like a movie, if it's rated 95 on Rotten Tomatoes, excluding the documentaries, it's probably a great movie. And it's rated a 10, other than being, an Adam Sandler, it's probably terrible. And so my odds of being someone who likes to look through recipes, we compiled this. Here are the top 10 for the New York Times. We've made a few of these. This chicken shawarma was great. Mac and cheese was super cheap. This bolognese, by the way, was unbelievable. What else do we make out of this? Roberta's. This is a Brooklyn-based pizza joint. They got a LA one now. It's some of the best pizza I've ever had. One of these. I did a horrible job of this no-knead bread, by the way. It's supposed to be super easy. There's a great video of it online. And the number one of all time, the world's best lasagna, which was like a solid 8. Not surprising. It's hard to mess up lasagna. I did it with Impossible Burger, so I'm not sure if that was too far away from the main gist of it. Anyway, lastly, one of the coolest discoveries show that time goes back much longer than the last month or year in political world. Someone's digging around their backyard outside of Verona on a farm and found an entirely intact Roman mosaic floor. Pretty cool, right? All right, guys, this was fun. Send us feedback. This is our first couple of these. Would love to hear more about the format. Should we invite some people on? Do you like the charts? Should we crowdsource the charts? Anything else? Shoot it back at feedback@themebfabershow.com. Thanks for listening, friends. You guys have a great weekend and good investing.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.